Welcome to the Markowitz, Fenelon and Bank, LLP video blog.
For leasing purposes, there's two main categories. So there's an operating lease and what's called a capital lease. So the capital lease is really treated on your books as if you purchased that piece of equipment. So it's a lease for leasing purposes and legal purposes. However, for treatment on your books, it's treated as if you own it. So it's just like a purchase, except that usually in a capital lease, the bargain purchase at the end of the lease is like $1. It's a negligible amount. So an operating lease is what we would refer to as a true lease, where the purchase at the end of the lease term is a market value type number. Some of the differences could be looked at from the perspective of taxation or from financial statement presentation. So a capital lease being treated as a purchase will make your equipment and assets go up and at the same time make your liabilities go up for your lease obligation, where an operating lease will not hit your balance sheet, will not make your assets go up, it will not make your liabilities go up. It's a true operating lease. It's just basically expensed as you make your payments. From a tax perspective, the ability to write those payments off compared to owning are very, very different. So if it's treated as a capital lease and a purchase, you have the ability to do the accelerated write-offs, such as Section 179 or bonus depreciations, whereas if it is accounted for and truly an operating lease, you're just writing off each payment as you make that payment. You have no accelerated write-off options. Many leases, when compared to an outright purchase, can be looked at quite differently as well. If you do an outright purchase, you're treating it as you are legally the owner, so you're not a lessor for terms of owning that equipment, or a lessee, excuse me. You own the equipment, your assets go up, your liabilities go up, and you have the ability to do the accelerated write-off. But the purchase option at the end, there is no purchase option because you purchased it up front. So you do have to look at the legal implications of outright purchases as well. Sometimes it's an economic consideration to look at the lease versus buy. The reason is if you buy a piece of equipment outright, you're financing that piece of equipment, usually through a bank or a lending company. And what financing options they may have versus a capital lease through a leasing company could be completely different. Sometimes there are financing arms of equipment companies, such as John Deere. If they have a financing arm and they're getting incentives to offer special lease finance rates, there could be better opportunities in one versus the other. And that's strictly from an economic perspective and borrowing cost analysis to see which one makes more sense. Because at the end of the day, the tax write-offs could be the same, but economics will drive that decision at that point in terms of lower costs of borrowing.
Thank you for watching. If you enjoyed this video, we invite you to subscribe to our YouTube channel.